Hello and welcome to Trade with Raymond. For some time now, I've been producing a few videos to help beginner traders and even advanced traders consider how to use technical analysis properly to be able to make profitable trades. Today, I'm looking at the CCI, that's a commodity channel index designed by Donald Lambert. Some time ago, in my early stages of trading, I believe MT4 used to call it Woody CCI. I think so, yeah. But I think over time it changed to the original CCI designed by Donald Lambert. I think Woody had a training room called the Woody CCI training room. I think that's what caused some trading platform to call it Woody CCI. But anyway, I may be wrong. But the tool is called CCI, originally designed by Donald Lambert. What it does is that it's bound between a positive 100 and a negative 100. That is, if it goes above a positive 100 or 100 itself, it means that we are looking at a bullish momentum. Prices are expected to go up. And if it goes to negative 100 and lower, that means that negative 100, negative 101, negative 102, it means that prices are falling further. It means that one currency is becoming extremely weak and the other is gaining strength. Similarly, if it goes to positive 100 and further, it means one currency, for example, the base currency, the pound, is beginning to gain a lot of strength. Now, we are preparing a meal. So you can't use just one technical analysis tool and say, well, this is what the market is doing. It's a combination. We are building a case. So for most people who claim that technical analysis is slow, is lagging, it's really not lagging, or it's lagging for a reason to give you a better projection of price behavior before you go into the market, as against rushing into the market because there's a big impulsive candle or a few successive candles giving some indication without looking at the facts of what technical analysis is saying. Now, adding this to what we've already done, going to the daily, I spoke about the ATR the last time. The last but one candle says that well, the market is expected to move 109 pips for the trading day. So if I look at from New York, no, rather from London section, and I stretch my tool, it says the market has moved 105 or 106 pips. See? See how accurate the ATR is. So for a trader who comes into the market, trader cannot say, well, I expect the market to continue, so I'm going to keep buying. The market has lost momentum because the average true range has been met. Market trends about, you say, 25-30% of the time. So if you have a major trendy day, you expect the market to continue, the ATR is giving you information that the market is going to reverse or the market is going to get choppy. So that's is a very powerful tool. Then the moving average is in order also gives you an idea of how fast the market is expected to move. The momentum, the orderliness of the moving average is important. I said that it's supposed to be a red, yellow, green. And so that's also very important when you're looking at trading. So putting the tools together gradually will help you come up with a complete technical analysis system to be able to make profitable trades. And in addition to that, trading is risky, so you must risk capital and make sure you have good enough trade training before you decide to make a trade. So you can ask your questions on the CCI, and also if you have any questions in relation to the moving average that I produced last time, you can also ask questions, and then the ATR, because the ATR is a very powerful tool. I took this trade, in fact, and then it rushed up quickly over here, and then we'll go on further to you know add the other tools, and after you have consumed this information and ask your questions. So thanks for watching and thanks for learning alongside. Have a nice trading day and bye bye.